Okay. So let's say we have seen that in a hypothetical situation during stress testing, in a worst case scenario, the USD they went long, speculating that the value of the other currencies, our forex currencies, the euro, the Japanese yen, the GBP, the AUD, the Australian dollar, and the Canadian dollar will, and the Chinese yen will, not Canadian dollar, the Japanese yen will appreciate, and then went long as we saw. They went long on 100 million via the euro, 75 million, 50 million on the GBP, 25 million in the UD, and the Chinese yen they went 20 million long. Okay, so but due to forex risk and things happen, they instead the USD has appreciated instead, meaning all the other currencies in our hypothetical stress testing scenario, all the other currencies has weakened or declined. Okay, so by 10%, that's our hypothetical. We are doing a stress test. So the current exchange rate for example, the USD to the euro is 1.1, right?
Yeah.
But after the 10% appreciation, so what's the value of the new value of the euro? It's 1 minus 1%. I mean 1 minus 10%. That's 1 minus 0.1. That's 0.99, right?
Yeah.
Yeah. So now the new value of the USD, a euro against the USD is 0.99, right? So now let's put in that to be the new in each. Okay. So basically there'll be a 10% value loss, because if you calculate 10%, 100% to be at the value that they went long, and then there is a 10% decrease or decline, or the forex risk has resulted in the USD appreciating by 10%, then against the euro that they went, it should be a 10% value loss in the value of the euro against the USD, or relative to the USD, and that will also apply to the other currencies. So, for example, 130, it's 130 minus 1.29.9, same 1.3, 1.29, 1.2 actually, yes.
Yeah, 130 minus
0.6, and then 6.4, right, for the Chinese yen. It's a 10% loss on each of the currencies. So 10% is 0.1. So we just subtract 0.1 from each, which will translate to a 10% loss. So that will also apply to the Japanese yen, the GBP, the sterling pound, the AUD, Australian dollars, and the CNY, the Chinese yen. So what can the Treasury Department at the JP Morgan Chase at the Manhattan branch do? They can come down and come up with a risk mitigation framework or strategy that will involve, for example, diversification. Because they went long, the long and short positioning didn't happen because of the worst case scenario that we stress tested. So they can decide to even diversify in more stable currencies that are usually commodity backed, such as the AUD and the CAD. Okay, so the JP Morgan Chase Bank Manhattan branch should not increase or concentrate much of their forex reserves on the specific currencies that are very highly volatile. In this case, the euro, and for example, the JBP, JPY, the GBP, and also the CNY. But they can increase their exposure to currencies that other currencies. There are many currencies, so they can design a diversification strategy to invest more in other currencies that are not directly related to the USD. In this case, so their long position and their short position is more hedged. Okay, for example, they can use other types of currencies that are less related to the, or correlated in this case, to the USD. Also, as I have said, they can also increase their exposure to the other currencies that are commodity backed, the CNY, I mean the CAD and the AUD, Australian dollars. But then another very critical point that they need to do in this case is now formulate the proper ALM rebalancing strategy to now rebalance their ALM mix, their asset liability mix and management, and also to now inform their capital buffer and cash and cash equivalent reserves that they'll need to maintain going forward, as per informed by this stress test that we just did, to ensure that they in the worst case, going forward, or in the worst case that such a worst case scenario happens, then they are better positioned. They have enough capital buffers of cash and cash equivalents, basically or majorly high or generally high quality liquid assets that can withstand such forex risk and also losses and also meet their short-term obligations such as surges in withdrawals, backruns, and also market crashes, basically or generally unfavorable losses. Okay, so to absorb that loss and also to be able to even comply with the Federal Reserve Bank in USA.
Yeah.
Okay, the requirements, for example, the liquidity management requirements, the Basel III requirements. Yes. So how will that now rebalancing strategy look? That rebalancing strategy, how will it look now? As we have seen, they will that rebalancing strategy on the ALM or ALM side. I mean, so since in this case the USD, they have in their worst case scenario simulation and stress test, the USD has actually strengthened. Then they need to sell some of their USD long situations because that long they need to short rather because going long did not help, right? So they need to sell some of the long positions that they hold because they have the USD, right?
Yeah.
Exactly. But they can also even reinvest, as we have said, they can reinvest in some of the currency pairs, and that will now also inform their LM strategy. So the LM strategy in this case will involve selling some of their long positions, which has not helped, and also reinvesting some of their, for example, they can buy treasury bills and bonds, and also forex reserves in other currencies that are less linked or correlated to the US dollar. Mhm. So we have seen so it's basically we have seen in that case they can do diversification hedging and also rebalancing their ALM. So ALM rebalancing and hedging, basically that's simple. That's what the treasury department of the JP Morgan Chase in this case in our hypothetical scenario and stress test should be able to do: diversify their funding sources or investment sources and also rebalance their ALM and also use some of the hedging strategies, derivatives, and also even the long position selling, shorting on some of the currencies that they speculated to go long and then went short.